Hi, everybody. Thanks for joining us today. I am Samantha, the webinar lead at Advice Chaser. Before we introduce our guests and get started, I need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for the educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by the presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on any information you hear today without consulting a qualified financial professional. We are thrilled to bring you this educational presentation today. Attendees are muted, and we encourage you to ask questions using the chat box or Q&A feature. The presenters will answer those queries during or after the webinar today as appropriate. If you have a question and want to put in the chat box, go ahead and leave your phone number as well. If we can't get to your questions during the event, we'll make sure somebody reaches out to you after today's event. We want this experience to be as educational as possible, so please do not hesitate to ask for clarification or expansion on the material presented today. And with that, I'd like to introduce you to today's presenter. Michael Ames is a financial advisor serving the Lake Norman region near Charlotte, North Carolina. Michael provides personalized investment advice to help you achieve your financial goals. As a graduate of Franklin University with a Bachelor's of Science in Financial Planning, he utilizes a one-on-one approach to develop a customized plan to help you grow, maintain, and transfer your wealth. Michael's goals is to develop a customized strategy which reflects each client's specific goals and needs. Michael has been happily married since 2011 and has two wonderful children. When not working or spending time with his family, Michael enjoys golfing, doing yard work, and spending time on the lake. And with that, I pass it off to you today, Michael.
Well, thank you very much. I really appreciate Vice Chancellor inviting me to do this. Retirement income planning is something that's very important. Obviously, pretty much everybody at some point in their life will hopefully be able to, retire and do it in a sound way. So with that, let's go ahead and get started. And the first thing that I always make sure that everybody understands before we go into any type of a process when it comes to retirement income planning is that you answer basically three basic questions. What does retirement mean to you? It means something different to everybody. When do you plan to retire? And then how long will retirement last? Those last two are always interesting conversations with people, but they're definitely something that each person should think about as they go before they even enter the retirement income planning process. So a couple things. So when it comes to the, when you want to retire, early retirement considerations. So I have never met a person that says that they want to retire later in life. Everybody wants to retire yesterday as a common theme. But there's a couple of things caveats that come with retiring early. Basically, first and foremost, you have less time to save money in a retirement plan or outside of retirement plan. If you retire earlier and your longevity of life or your life expectancy is longer, then there's a longer amount of time that your assets have to be there in place to ensure that you don't outlive them. If you take Social Security early, something we'll talk about later on in this presentation, but if you take Social Security early, there's some ramifications around that. Same with healthcare and Medicare, as well as potentially impacts on your pension benefits. So anything that you look at here, anytime you want to retire earlier, it doesn't mean that you can't. It just means that you want to take all of these things into consideration before you make that decision to do so. On the opposite side of that, delaying retirement gives you more years to accumulate assets. You tend to have a shorter distribution period. Social Security, if you decide to wait, could be more beneficial to you. And then impact on healthcare a lot of times has more to do with Medicare than it does anything else. But basically, they're the two ends of the spectrums that we see. You get to a spot where delayed retirement is potentially the only option. That is something that you and a financial professional would want to sit down to make sure that you understand, the reasons that would be. The next thing that you want to consider is, and I do see this with clients that I work with, I do see people who like to work during retirement, and working doesn't necessarily mean a full-time job. It just could mean, as she mentioned at the beginning, I like golf. I pretty much am sure that every one of the starters at the golf course is retired, and they do this as a part-time job. If you think about it, it puts a less of an impact on your savings. Some people just use it as spending money. There are people that work, retire early and then decide to, from their main job, but get a job maybe part-time that offers healthcare that bridges that gap to Medicare. One of the things you would want to consider when it comes to Social Security is if you retire early and by early, let's call it 62. If you retired at 62 and wanted to start taking Social Security, not only will your Social Security benefits be impacted by a reduction of their benefits by up to potentially 30% less that you would receive, you also have to consider that there's maximums that you can make in retirement. I think the most recent year, it's like a little over 21,000 in 2023 that you can earn before your Social Security benefits get further reduced. So all things, a conversation I had recently with a client was around this. They want to retire early, but and work, basically retire from their job they've been at for 40 years because they're tired of it. Want to go do something different, want to take Social Security. We talked about if they decide to do that, we got to make sure they pick the right kind of job, that it doesn't increase their income to a level that actually negatively impacts them. Basically, the non-financial benefits that we're talking about here would be something along the lines of if it affects your pension, if it potentially affects other kind of benefits that your company offers you. You don't tend to see this as much anymore, but you used to have like company cars and those types of things that could potentially create an additional need for your savings if you decided to retire early. The how long will retirement last conversation is probably my least favorite conversation that I have with any client, because you basically have to try and guess when you're going to die. Not exactly a fun one, but it is something that everybody has to consider. The general general kind of way that I go about it, or a lot of financial advisors go about it, is we will plan on somewhere between 90 to 95 years old as a kind of case study that we use to test your portfolio, look at it, make sure that the amount of money that you're taking out doesn't reduce to zero at various different circumstances depending on the markets and whatnot at a too early of an age. The way that I look at it is if you have a good sound retirement income plan, you really want to have it set up that there is almost ensure that there is no way that you could outlast it. Not everybody's plan can do that, but it is something that you definitely want to consider when making a decision of when you would retire. The other part too is when we look about retirement income planning goals, it's really that conversation of what does retirement look like for you. You don't want to retire you don't basically retire and then hopefully or you wouldn't want to retire and then sit there and do nothing. Hopefully you've worked your whole life, you save up, and then you have that ability to no longer work and actually enjoy your retirement. These little golf clubs there, that would be for me probably. But I have plenty of clients that say they want to travel more often. They want to go see kids, grandkids, etc. They want to, maybe buy a second place, that they can travel to and whatnot. But basically, you want to kind of think of what you want to do to enjoy retirement. Again, we talked about managing the risks of outliving your income. That is, I think first and foremost, you would want to make sure that that's in place before you retire. And then the last item there, addressing the risk of unexpected life events. When we talk about this, it'll come up later in the presentation here, but a lot of times I tell people it's not you dying that would potentially impact a surviving spouse's ability to continue to live in retirement. It's actually you potentially living with enhanced medical issues. the need for extended care and whatnot. Those unexpected life events that really can put a strain on any kind of financial plan. So these are the three things you really want to consider, and you want to make sure that you're checking off those boxes before you jump into retirement. And with that, we kind of want to look at this slide as we'll talk really kind of the meat of what we're going to talk about today, the retirement income planning process, the actual process of it. How much do you need? The major factors that could impact your portfolio, where you're going to get your income from. Once you know that income, what the gap is between your spending and your income, and then how do you use your savings? And the reason it's a flywheel here, and it doesn't just stop at the use your savings, bridge the gap, is life changes, and you might have situations that you're going to need more income, or there might be situations where you don't. If you pay off a mortgage or whatnot, you don't need as much income. So it's just an ongoing process, really, that you do your best to kind of come up with a good framework as you enter retirement, and then you use that and continue to adapt as needed year after year. So when we start with how much annual income, you'll see here, there's some guidelines general guidelines of the 60 to 90%. But I will just tell you personally, the way that I look at it, I actually start with the last item there, list your expenses. I basically give every client that I work with a homework assignment, and you essentially write out, what are those fixed expenses? The mortgage, if you retire before Medicare, what does health insurance cost? You got auto loans, et cetera, right? What are those different expenses? Once we know those expenses, and if we kind of also add in those other things that you want to do, like we said, the travel, the hobbies, golf, boating, whatever it might be, add in those other things that you want to do in retirement, you come up with the number that you actually will need. How much money do I need to spend, or do I want, say kind of a combination of need and want, right? It's what do you need to spend are those fixed costs? What do you want to spend? And then we back into how much money we actually will need to generate, whether that's from Social Security, pension, savings, whatever, to make sure that if we can hit those with those three items, can hit your spending needs, then that usually will help create a sound retirement. The accounting for healthcare costs, this is very important. It is something, once you hit Medicare at 65, it does ease the potential burden on the healthcare spending, just because the premiums are usually significantly less than what going out and buying a healthcare policy would be in the open marketplace if you decided to retire early. You do need to consider the prescription drug coverage, any kind of supplement. Medicare does not cover everything. A lot of times you will need to have some sort of a supplemental plan. And then also the long-term care. We talked about those unexpected life events. It is a misconception that Medicare covers long-term care. There is a component that they do cover, but it does end at 100 days. So you kind of, whether it's happened to you personally in your life, somebody, family member, friend who's ever gone through any kind of whether it be a health concern that they needed assisted living or home health care assistance, or dementia, Alzheimer's are becoming more and more prevalent. As we look at that, these are the kind of things that we want to make sure that we're addressing early on before retirement, because as you get older, they become harder and harder to account for where we would use those savings if we didn't plan for it earlier on in life. So when we look at that, there's some other major factors that you want to consider. When we look at the, if you go to the next slide, and it'll have it on there. Yep, thanks. Sorry. So when we look at this, I think the first and foremost, this is a topic that everybody is looking at right now: the accounting for inflation. Right? What are things that can increase those expenses that we had talked about previously, in a way that is outside of anything that you originally had planned on, right? When inflation for the previous 10 years up until the last year had been running about 1.5 to 2% a year, and then now all of a sudden we started to see 9% last June, and then that hovering way above the 4% number annually for the last year. That has put a strain on a lot of people's ability to continue to live comfortably in retirement if you had not planned for this potential impact. When we talk about the impact on taxes, a lot of people don't really think about what that really means. Taxes are a situation where if you only have money that's in pre-tax accounts like 401ks and whatnot, that actually can really negatively impact your ability to retire. So kind of one of the things I want to look at when we look at this slide here is it's you want to make sure that you're sitting down and you're reviewing with your financial professional where your accounts are. What I mean by that is, are they Roth IRAs, 401ks, traditional IRAs? Are they taxable accounts and brokerage accounts and whatnot? What are the different tax ramifications of where you pull money from? So you want to make sure you know all of this stuff ahead of time before you retire. With this slide, I want to kind of go into, this is really something I think that's very important to look at, not only pre-retirement, but even in retirement. It's something that we're going through right now. I mean, think about the last, really since COVID, right? So, we had the major drop in the stock market in March of 2020. Then we had the quick rebound into 2021. We had a really negative year last year that just kept on seeming to get worse day after day. So far this year, knock on wood, we've had a good recovery so far. But basically the point of that is, think about if you retired in 2020, what that market roller coaster looks like. Is your portfolio set up for that? Something we'll talk about here in a second, a little bit more in detail. I'm going to skip the reinvestment risk and come right back to that. Interest rate risk. So think about what we've seen. We had interest rates next to zero for basically since 2008. Now, within the last year, we're seeing CDs, short-term CDs at 5+% interest, things we have not seen in a decade plus. So interest rate risk being the idea that if you have investments that are sensitive to interest rates, like bond funds or short-term, long-term fixed income investments, you want to make sure your portfolio is set up that. Going to the reinvestment risk, though, this is where it comes in. I have a lot of people talking to me about, hey, I can get a 5-month, 1-year CD at 5%. Why would I want to do anything longer term? Well, reinvestment risk is the opposite of the interest rate risk. It's the idea that once your CD or your fixed investment matures, are you going to be in a position where you're able to continue to get the interest rate that you need? Going back to the most recent time that we have seen this, look at 2008. I remember working then and having clients come to me and saying, I've got this 5, 6, 7% CD, and that's what I want. Well, guess what? We had interest rates down to 0, 1% after the financial crisis. So that reinvestment risk, you're no longer able to generate the same level of interest or income that you were before. All things that you want to make sure that these three are huge risks to any financial plan. And we can't guarantee all the stuff in the future, but what you can do is, if you have a sound plan that allows your accounts the ability to adapt to market changes, you're in a much better financial position than if you just kind of go blindly into it. When you look at the sources of retirement income, this is a conversation I have all the time. I talk about the three-legged stool. This is a core, just kind of core foundation of any retirement income plan. So first and foremost, think of the three-legged stool that you have at a bar or table, whatnot. One leg of that stool is the Social Security, right? We'll talk about what impact Social Security has here in a second, but Social Security is one of those legs. You have employer pension. Hopefully you're fortunate enough to have an employer pension. But then in theory, historically, this is what kind of for the last 50+ years, this is what a retirement income plan composed of, and we'll talk about what the problems of that is in the future here in a second. But you had one leg is Social Security, one leg is the employer pension, and then the third leg is your individual savings and investments. You know, sound stool that you could sit on and comfortably know that it's there for you going forward. So Social Security, just some basics here. Obviously, everybody's situation is different. So you would want to really dive into your own, and you can find out more specifics if you actually go to the Social Security website. You can actually find specifics about your options of if you take it early at 62, your full retirement age, whether that's 66 or 67, what the impacts are if you delay it to age 70. All those things you can find it specifically about your situation, but it is something that you want to, I would highly suggest if you take away anything from here, run through that exercise for yourself, as it is, as we mentioned, one of those three legs of the stool there for for your income planning. But that is, you know, a key component of it as you build out that stool. The employer pension, you know, if again, you don't see very many of these anymore. A lot of companies are getting rid of them. I got rid of them a long time ago. They're expensive for companies to run going forward. I would say if you do have one, yeah, that's fantastic. And here are the kind of things that you want to consider. You know, what are your payment options? You know, if you're single, it may be the single life annuity. You know, that gives you essentially the highest income for your life. That's fantastic. If you're married, you want to consider what qualified joint selections you have. You know, there are different, you know, whether it's both of you have the same amount, no matter who outlives the other, there might be a reduction in benefits, whatever it might be. When you look at the other options, the lump sum, the conversation you basically want to talk about with your financial professional of whether taking a lump sum amount out and using that money to kind of build into the savings. You know, that's the better option. Those are things you want to consider. Does your pension, if you have one, does it have inflation adjustments to it? Some do, some don't that I've seen. Basically, the bottom line is you want to read that plan and explanation of benefits. Usually a giant document that goes through every possible situation. And I would highly suggest sitting down with somebody to go over that, as it can be a little cumbersome if you're trying to do it yourself. But again, if you have an employer pension, fantastic, as you know, be in that second leg of the stool. So let's look at, before we get to the third leg of that stool, we kind of look at it and say, okay, it's a basic equation. How much money do I need? You know, I'm going to give you an example. I need $10,000 or $5,000 a month to live on. Let's even move something for her. $5,000 a month I need to live on. Between Social Security and my pension, again, fortunate enough to have it, I'm getting $4,000. Well, then we need $1,000 additional annual, this is annual. I'm gonna say it's monthly just to keep my numbers simple. You know, to keep it, you need $1,000 a month, $12,000 a year that your savings need to generate for you to comfortably live in retirement. We don't have that pension, and now we're just relying on Social Security. Let's say you're only getting $2,000 a month from Social Security. Well, now you got to come up with $3,000 a month or $36,000, within 12 to 36 in that example, that your savings need to account for. Something that, again, you know, one of the things that a lot of people, you know, if you're on this webinar, if you don't have a pension, I'm sure you're familiar with it. Maybe your parents or other relatives had it. It really did help with a comfortable retirement. That nowadays there's a lot more onus on you as the individual to create a sound investment strategy to meet that larger gap. But the key here is identifying that gap first before you determine if you're able to retire. So just kind of general considerations here about, you know, the savings. We'll go into each one of these in a little bit more detail here in a second. But what does your investment strategy look like? What are the specific investment and options you have? What are the different products you have available to you? What withdrawal rate should you take? What order of withdrawals? That is very, very key. We'll talk about that here in a second. What are the order of withdrawals from the various accounts? How does that make a difference? And then required minimum distributions kind of come into play with that order of withdrawals. That's something you always want to make sure that you're thinking about. So asset allocation or investment strategy. So when you're thinking of that, the old adage was, and it kind of makes sense. It generally makes sense as you get older or near retirement, you generally become more conservative with your investments. Look at a year like 2022, it almost didn't matter whether you're aggressive or conservative. The market really hit kind of everybody's accounts the same way. It was negative across the board. But in general, you tend to see you get more conservative as you get closer to retirement because you can't take that kind of risk to build up if the market drops to recover from it. So you want to manage the asset volatility. You want, if you kind of look at a sound asset allocation, there should be some component to the stock market, some component typically to bonds or fixed income, and potentially something to alternative investments that kind of give you diversification that allows hopefully your portfolio to keep pace with inflation, enhance the likelihood that it will outlive you, basically making sure that you always have access to assets and income while you're alive. And this just quickly kind of goes over this slide, and actually you can go ahead and go to the next one as well. Basically, that just gives you, the types of investments that there are. Essentially, it's, mutual funds, individual stocks, bond funds. There's all kinds of CDs and whatnot. Just know that a good sound asset allocation typically encompasses, if not all of these, but several of them to build out a good diversified strategy. So when we look at annuities, when one of the things that I talk about with people is before just writing off annuities, because there are several different types of them, whether it's variable, fixed, indexed, income, single premium income, there are several different types. I always talk about it like housing. When we talk about housing could mean something different to everybody. Could mean you live in an apartment. Well, that's housing to you. Could mean a single family house, condo, whatever it might be. They're all housing, but they're different types of specifics there. Annuities are the same way. There are several different types of them. You'd want to sit down with a financial professional to see if any of those types make sense for you, but they've become more and more prevalent as a way to replace the quote unquote the pension leg of that stool. As we talked about, the vast majority of the people, and I'm sure the vast majority of people listening to this that I see don't have access to an employer pension. They just don't typically exist that much anymore. With that said, though, this is a potential way to replace that leg of the stool. If you think about it, if you have Social Security as one leg, no pension, and you're saving, that's a two-legged stool. It is very, very difficult, almost impossible, to sit down comfortably with just two legs of a stool without tipping over. Think about that as your retirement plan. I'm not saying annuities are for everybody, and they may not be needed in your specific situation, but they are something that you would want to consider potentially looking at to kind of create that third leg of the stool going forward for your plan. Withdrawal rate, kind of one of the things you see this in that fourth bullet point item there. Typical withdrawal rate that you see, it's an old adage, but it's basically 4%. If you get $1 million portfolio, you can generate, you take 4%. Hopefully you'd be able to comfortably take $40,000 a year out of that account. And if you have a sound asset allocation, investment strategy, diversified portfolio over a long period of time, that should hopefully be able to accommodate that 4% withdrawal rate. I will tell you this, everybody's situation is different. If you use the initial kind of thought process of coming up with what are your expenses, what are potential future expenses, we talk about current versus future needs, it doesn't, and then you kind of figure out what that percentage is, using that 4% kind of as a benchmark. Again, not for everybody, but as a benchmark. If you come up with your percentage and let's say it comes out at 15% withdrawal rate that you need from your investments, well, that may not be something that's sustainable over time. If you come out and it's 2%, then you might be in a position that it makes that it's easier for you to, lesser that you're taking out today, more money in the future that would hopefully be there to meet those unexpected needs going forward. The order of withdrawals, the types of accounts you take. We talked about, whether it's traditional IRAs, 401ks. When I say those, I'm talking about them as pre-tax investments. You did not pay tax on them today. The money grows tax deferred. When you go to take the money out, that's when it's taxed, and it's taxed at ordinary income. Roth IRAs, you pay the tax on the money going in today. It grows tax exempt tax deferred. And then when you go to take it out, it is tax exempt as long as you meet the various rules of over 59 and a half and whatnot for there. And then taxable accounts are your brokerage investments, your non-IRAs that you will pay, you get a 1099 annually for pay tax on dividends and capital gains and whatnot. So when we talk about this, when I look at it, let's say you've got a taxable account, a Roth IRA, and an old 401k that you rolled over to a traditional IRA. When we look at required minimum distributions, currently, under the current law, and it is going to change under the most recent Secure Act, it does go from age 73, and eventually will go up to 75 in the future years. But for right now, the year that you turn 73, you have to start taking a minimum amount out of your IRA. Well, if you think about this, if you've only taken money from the tax exempt, the Roth IRA, and the taxable account, because that was in your mind the lesser tax impact today, then all you're left with is your traditional IRA. Well, now you're in a spot where you might have to be taking out more than what was necessary if you would have planned appropriately. And if you retire at 65, you've got 8 years to plan to potentially take maybe a little bit from each account. And so you allow yourself various options to kind of lessen your tax burden today and lessen especially what it could be down the road. You don't want to lock yourself into higher tax brackets if it's not necessary. So it's something you definitely want to sit down. It's a lot of the planning that I do with clients is specifically around this. If we plan accordingly as you get into retirement, we have various options of where to pull from in retirement. It'll lessen your tax burden. It allows your portfolio to last a lot longer, and it actually can potentially reduce that withdrawal rates if you do it the right way. So something you definitely want to look at and consider. So with recap, when do you, again, when you go to the when do you plan to retire, it's my favorite question when I talk to people. When do you realistically want to retire? My daughter, who's 10 years old, actually, I told her I was doing this presentation today. She asked me, I'm 40. She said, when do you want to retire? I said, yesterday. She goes, no, really? I said, probably like 65, 67. Who knows, right? Maybe if things go right, maybe I can retire earlier. If I really love what I do, which I do, maybe I go longer. Maybe I do this a little bit part-time. The point is, when do you want to retire realistically? Looking through here, I would say the biggest things that you want to account for are, what are your expenses? Those are the biggest things. The less amount of fixed expenses, hopefully if you can get your mortgage paid off soon prior to retirement, you don't have a car loan. That's not, obviously everybody can do that. But you'd want to sit down, and if you can account for the lesser amount of expenses, then your portfolio doesn't need to generate as much. And it allows you to more comfortably live through retirement. Again, that number is different for everybody. Everybody's number is different. So when anybody tells you you need X number of dollars to retire, all I ever say back to that is, well, you don't know my personal situation. Everybody's number is different. So the key, I think, hopefully takeaway from this for everybody that's listening is to really dive into your own personal situation. What amount of my expense is going to be? How much do I have saved up? Am I able to create that three-legged stool? If you can comfortably answer all those questions, usually that means you're on the right track to having a sound retirement income plan, and it makes retirement much more enjoyable as you go forward. So with that, I want to, like I said, thank you guys all. I'll transition it back over and we'll go from there.
Yeah, but thank you for that awesome presentation. I definitely left with a lot more that I did not know, especially the After age like 73 and up, I had no idea. I would not have known prior to this presentation. On our screen, we have a slight disclaimer. Feel free to screenshot that or it will be available in the recording. And with that, on behalf of the Advice Chaser, we want to thank our speakers and organizations that have worked with us to bring you this webinar today. Thank you so much for attending, and look out for an email soon with a link for the replay of this event. You're welcome to share that replay with your friends and family. Here at Advice Chaser, we are all about helping you with find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon.